If your checking account is free, that just means someone else is picking up the tab. And the weird part is, it may not be the app you trust with your paycheck. That logo on your phone? Sometimes it's basically the costume, not the bank. Which gets awkward fast when you remember FDIC insurance is up to $250,000 per depositor, per insured bank, per ownership category, not per app icon you tap half asleep at 7 a.m. So this isn't a fintech hit piece. It's a reality check. Who actually holds the risk, who pays for the perks, and what happens when the money faucet gets turned off. Keep going, because this matters more than the branding suggests. Long before sleek finance apps started acting like they invented money, banking was already a heavily guarded club. Licenses, deposits, card networks, settlement rails, compliance manuals thick enough to stop a door. After the bank runs of the 1930s, the US built a system around trust and supervision, and the FDIC became part of that bargain. Your grandparents would not have called it sexy. They would have called it, "I'd like my cash to still exist on Monday." Then the modern economics started shifting under the floor. In 2010, the Durbin Amendment came in, and Regulation 2 helped enforce one very specific pain point. Debit interchange for banks with more than $10 billion in assets got capped. That matters because interchange is one of those boring words that secretly pays for a lot of free stuff. So large banks earned less on debit swipes, and smaller banks, partner banks, and new middlemen suddenly had an opening. Not to reinvent banking exactly, more like to repackage it and distribute it better. And then came the sugar high. In March 2020, the Federal Reserve pushed the Fed funds target down to 0% to 0.25%. Money got absurdly cheap. Venture capital started treating customer acquisition like an Olympic sport. Free accounts, cashback perks, early direct deposit, no fee this, boosted APY that. In 2021, global fintech funding hit $132.4 billion, which looked like proof that the future had arrived. But a lot of that future was a gorgeous new storefront built inside an old building with ancient plumbing. The walls were painted. The pipes were still the pipes. Then rates snapped higher. By July 2023, the Fed funds target was 5.25% to 5.50%. And that's when the quiet assumption broke. Maybe this business only looked elegant when money was basically free. Imagine Tom downloads a finance app because it looks clean, promises no monthly fee, and gives him a shiny card in 3 days. He thinks he opened an account with the app. Not really. Here's the stack. First, there's the app you see. That's the interface, the brand, the push notifications pretending to be your financial therapist. Under that, there's usually a middleware layer called Banking as a Service, or BaaS. Plain English. Software and operations that let a non-bank plug into actual banking infrastructure. Under that sits the sponsor bank, the part with the charter, the compliance burden, and the legal obligation. Sutton Bank has played this role for some fintech programs, and it's a useful example because it shows the point. The real asset is not the app. It's the license. Then the card network moves transactions, and the underlying rails handle settlement and custody. So where does the money come from? Tom swipes his debit card, and interchange gets generated. Remember that $10 billion threshold from Regulation 2? It matters because debit economics differ depending on who sits where in the stack. Meanwhile, deposits can earn spread. And for years, venture capital covered the gap between what users paid and what the product actually cost. Here's where it clicks. The app is the menu. The sponsor bank is the kitchen, the liquor license, and the health inspection. One is what you interact with. The other is what makes dinner legal. Maybe it's just normal startup losses. Short answer, not exactly. Because if the app disappears, the bank accounts and payment rails can still exist in some form. But if the banking partner or the underlying rails stop functioning, the app becomes a very attractive screenshot. The logo owns your attention. It often does not own the liability. Here's why you should care even if you never think about bank plumbing until it leaks on your shoes. When the Fed moved from 0% to 0.25% in March 2020 to 5.25% to 5.50% by July 2023, the cost of money changed everywhere. And for app-first finance companies living on thin margins, that was brutal. because venture cash got less generous. And because funding got pricier, the "we'll figure out profitability later" era started dying on camera. So the chain reaction hits you fast. Perks shrink. Savings rates get less impressive. Cashback offers quietly lose some sparkle. A no-fee account starts experimenting with premium tiers, transfer charges, or stricter overdraft rules. Support gets slower because cutting humans is cheaper than fixing the model. And yes, instant transfer turns out to be a marketing phrase, not a law of physics. Then there's the more unsettling part. On April 22nd, 2024, Synapse filed for Chapter 11. That mattered because Synapse was part of the invisible layer connecting fintech apps to banking services. In other words, the issue wasn't just some brand having a bad quarter, the plumbing broke. And when plumbing breaks, people suddenly care a lot about plumbing. That can hit your actual life in dumb, painfully practical ways. Your rent autopay fails. Your mortgage payment lands late. Your emergency fund feels less emergency when access gets messy. And when that uncertainty shows up, people change behavior. They split cash across multiple institutions. They keep a second account just in case. They stop trusting the app to be their whole financial life. Higher rates hurt every startup, sure. But businesses that depend on partner banks, subsidy spending, and fragile middle layers get exposed faster. And that's the real annoyance. Free can get expensive right when you need stability most. The lazy take is that fintech is fake. That's wrong. Some of these companies genuinely made money easier to move, easier to understand, and less annoying to manage. Better design matters, faster onboarding matters, lower costs matter. A lot of legacy banks treated user experience like a hostage situation, but the other cartoon is wrong too. The one where every polished finance app is a clean sheet reinvention of banking. A lot of what gets marketed as disruption is really distribution with better fonts, and that distinction gets ignored because the visible part is fun. The card, the app, the neon gradient that says your money finally has vibes. The invisible part is compliance, licensing, settlement, sponsor bank dependencies, funding structure, which is incredibly boring right up until it ruins somebody's Friday. So the real picture is simpler and more uncomfortable. Innovation is real. Fragility is also real. Those two things can coexist in the same product. What people miss is not whether the app feels useful. It often does. What they miss is whether the economics stand on their own or are still leaning on borrowed infrastructure, borrowed balance sheet strength, or borrowed time. And honestly, consumers often make that trade willingly. Convenience now, clarity later. The problem is later has a habit of showing up all at once. So that's the whole story. The slick part you touch is often just the storefront, while the real economics live underneath, out of view. And that's why I make these videos, to drag the hidden machinery into daylight before it becomes your problem. So I'm curious, if your favorite money app lost the perks tomorrow and priced itself like an ordinary bank, would you still keep it? Free checking is only free until someone stops paying.